From 1970 to today, how inflation stole your wealth and the AI system that fights back. In 1970, a brand new car cost $3,500. A house in a typical American suburb cost $23,000. A gallon of milk was 33 cents, a movie ticket was 1.55, and the average American household income was just under $10,000 a year. Today, that same car costs $48,000. That house costs $400,000. The milk is $4.50, the movie ticket is $15, and the median household income is around $75,000. Here's the question nobody asks. If incomes went up 7.5 times since 1970, why does everything feel so much harder? Why do people earning more in absolute dollars than any previous generation feel like they are falling behind? Why does a salary that would have felt like extraordinary wealth in 1970 barely feel like enough today? The answer is inflation. Not the version you hear about on the news every month, the real version. The one that has been quietly transferring wealth from ordinary people to assets and institutions for over 50 years. And the version that most people have no idea how to fight. Today, we are going to track exactly what happened to the dollar from 1970 to now. We are going to see which decades were the most destructive, which categories hit everyday people the hardest, and why the conventional wisdom about inflation has failed most Americans. And then, I am going to show you how AI is changing the way smart people protect and grow their money in an inflationary world. To understand what inflation really does to ordinary people, you have to start with the 1970s. Because the 1970s were when inflation stopped being a background economic force and became a genuine national emergency. In 1970, the inflation rate in the United States was around 5.7%. High by the standards of the previous decade, but manageable. By 1974, it had climbed to 11.1%. By 1979, it peaked at 13.3%. And in 1980, it hit 14.8%, the highest rate in modern American history. To put that in plain terms, if you had $100,000 in savings in 1970 and you did nothing with it, just left it in a bank account earning minimal interest, by 1980, that money had lost nearly half its purchasing power in one decade without a single bad investment, just by sitting still. What caused it? A combination of forces. The collapse of the Bretton Woods system in 1971 took the US dollar off the gold standard, giving the government the ability to print money without a hard limit for the first time. Oil shocks in 1973 and 1979 drove energy prices to levels nobody had anticipated. Government spending on both the Vietnam War and domestic programs had pushed too much money into an economy that could not absorb it cleanly. The people who survived the 1970s financially were not the ones who worked harder. They were the ones who owned things: real estate, commodities, businesses, physical assets that inflated alongside the cost of everything else. The people who stayed in cash or bonds were quietly destroyed. This was the first major lesson that inflation teaches. Cash does not protect you. Assets do. The 1980s, the cure and its consequences. By 1979, Federal Reserve Chairman Paul Volcker had seen enough. He made a decision that was politically brutal, but economically necessary. He raised interest rates to levels that had never been seen before. The federal funds rate peaked at over 20% in 1981. It worked. By 1983, inflation had dropped to 3.2%. The crisis was over. But the cure left scars. The early 1980s recession was severe. Unemployment hit 10.8%. Businesses that had borrowed at variable rates were suddenly paying interest they could not afford. The housing market collapsed in many regions. Farmers who had borrowed heavily against land values were wiped out when land prices fell and interest costs exploded. But for people who had assets and cash at the right moment, for people who could buy when everything was on sale, the 1980s were one of the greatest wealth-building opportunities in American history. Interest rates at 15% meant that bonds and CDs were paying extraordinary returns. Real estate recovered, and then surged through the rest of the decade. The lesson of the 1980s: inflation crises create destruction for the unprepared and opportunity for the prepared. The difference between those two groups is almost always a system, not luck. The 1990s and 2000s, the illusion of stability. From the mid-1980s through the 2000s, inflation was relatively tame. The 1990s averaged around 3% annually. The 2000s averaged around 2.5%. On the surface, this looks like a solved problem. Inflation was under control. The economy was growing. Technology was booming. But underneath the headline numbers, something important was happening. Specific categories of spending were inflating at rates far above the official measure. Healthcare costs were rising at 6 to 8% per year throughout this period. College tuition was rising at 5 to 8% annually. Housing in major urban areas was climbing far faster than wages in the same markets. The official inflation measure, the Consumer Price Index, captures an average across all categories. It does not tell you what happened to the specific expenses that matter most for long-term financial health. And throughout the 1990s and 2000s, the things that were most critical for building a stable life, education, healthcare, housing, and growing cities, were inflating at 2 to 3 times the official rate. This is what economists call K-shaped inflation. The things poor and middle-class people spend the most on as a percentage of their income inflate faster than the things wealthy people spend on. The result, over decades, is a quiet but systematic transfer of purchasing power from lower and middle incomes to upper incomes and asset holders. The 2010s brought a new form of inflation that was even harder to track. After the 2008 financial crisis, the Federal Reserve pushed interest rates to near zero and kept them there for most of the decade. The result was not traditional consumer inflation. Instead, money flowed into assets, stocks, real estate, private equity, collectibles, anything that could store value. The S&P 500 returned roughly 250% during the 2010s. Home prices in major markets doubled or tripled. Meanwhile, wages for non-college educated workers grew at roughly 2% per year. If you owned assets in the 2010s, your wealth grew dramatically without you doing much of anything. If you did not own assets, if you were renting, saving in a bank account, or spending everything you earned, you fell further behind in real terms, despite the official inflation number looking perfectly benign. The decade of the 2010s proved something critical. Inflation does not always show up in the grocery store. Sometimes it shows up in the price of the asset class you do not own yet. And by the time most people realize it, the opportunity to get in at a reasonable price has already passed. Then came 2021 and 2022. The fastest inflation spike in 40 years. Inflation peaked at 9.1% in June 2022, a number that most people under 50 had never seen in their lifetime. Groceries up 10%, energy up 30%, used cars up over 40% at the peak. This was the first time in decades that inflation was impossible to ignore. It was not hiding in healthcare premiums or college tuition. It was showing up at the gas pump and the grocery checkout every single week. And for the first time in a generation, ordinary people felt the full force of what inflation actually does to purchasing power in real time. By 2040, the official inflation rate had come back down to around 3%. But the prices did not come back down with it. Inflation measures the rate of price increases, not the level. Prices that went up 20% during the spike stayed up. The new baseline was simply higher than before. From 1970 to today, the cumulative inflation rate in the United States is over 750%. A dollar in 1970 is worth less than 13 cents today. The people who protected themselves through this 50-year period were not the ones who saved in cash. They were the ones who owned assets, invested consistently, and built systems that made their money work against inflation rather than sitting still while inflation worked against it. This is where AI changes the game. Understanding inflation historically is only useful if it changes what you do today. And here is where AI gives everyday people a tool that simply did not exist before. The most powerful thing AI can do for your personal inflation protection is calculate your personal inflation rate. Not the official CPI number, your number. The rate at which your specific cost of living is actually increasing based on how you actually spend money. Here is the prompt. Give the AI your actual monthly spending broken down by category. Then ask it to apply the real historical inflation rates for each of those categories over the past 5 years and calculate your personal inflation rate. Then ask it what your spending in each category is likely to cost in 5 years, 10 years, and 20 years if current trends continue. Most people discover their personal inflation rate is significantly higher than the official number. If you own a home in a major city, send children to college, and have ongoing healthcare costs, your personal inflation rate might be 5 to 7% per year, even when the official measure says 3%. That changes everything about how you need to invest. The second way to use AI is to stress test your investment portfolio against historical inflation scenarios. Tell the AI your current investment allocation. Then ask it to model how that portfolio would have performed during the 1970s inflation crisis, the 2008 crash, and the 2021 to 2002 spike. Ask it to tell you which assets in your portfolio are inflation resistant and which ones are inflation vulnerable. Then ask it the most important question. Given my situation, what specific changes to my investment allocation would give me the best protection against a sustained period of high inflation while still allowing for long-term growth? AI cannot predict the future, but it can look at 50 years of inflation history and tell you which asset classes have protected purchasing power across multiple inflation environments. Real assets, dividend-growing stocks, treasury inflation-protected securities, real estate, commodities exposure. The people who understood this in 1970 went into the decade holding the right things. The people who did not watched their savings quietly evaporate. Here is what 50 years of inflation teaches us when you look at it clearly. Inflation is not a news story. It is not a political talking point. It is a permanent feature of the economic environment that you are either positioned against or exposed to. There is no neutral ground. The 1970s rewarded asset owners and punished savers. The 1980s rewarded the prepared and punished the overleveraged. The 1990s and 2000s quietly inflated the costs of the most important things in life, while the headline numbers looked calm. The 2010s inflated asset prices and widened the gap between owners and non-owners. And the 2020s reminded an entire generation what it feels like when inflation becomes impossible to ignore. The pattern is always the same. Inflation transfers wealth. The direction of that transfer is determined by what you own, what you owe, and what system you have in place to adapt. You now have a tool that previous generations did not have. Use AI to calculate your real inflation exposure. Use it to stress test your portfolio. Use it to understand how your specific spending patterns are affected by inflation in ways the official numbers will never show you. The dollar has lost over 90% of its value since 1970. The next 50 years will bring the same forces. The only question is which side of that transfer you are going to be on. If you want the complete system for building wealth that outpaces inflation over the long term, watch this video next. Everything starts there.